Managerial finance and cash flow, a new topic in our course. So today we're going to construct the cash flow through different approach, direct and the indirect, which is the most common approach that we use it in managerial finance. Why cash flow is important? Why it is very attractive to many businesses to prepare their own cash flow. Cash flow is completely different than profit. So cash flow and profit are different according to the link of the accrual accounting. So cash flow details is coming from income statements and balance sheet. So the details of incoming and outgoing flow of money, while from the balance sheet, income statement, it is important because it will affect our economic data. So if we see here the BS and the IS, which is the balance sheet and the income statement, if we go to the BS, which we are going to start with the balance sheet at the start, are the components of the balance sheet, and then we see the cash flow from the income statement, either inflow or outflow of money, and we are going to end it by the balance sheet at the end. So we need to know the importance of this cash flow that reflect profit related and non-profit related. Profit related, which is inflow, and non-profit related, it is an outflow. So we're going to relate this operating activity to the investment and financing activity to see if we have enough cash or not. So what is cash flows? The cash flows is important because it assists the company ability to manage cash. Do we have enough cash or not? To assist the firm ability to generate cash. Can I have enough liquidity to meet the company obligation, to pay dividends, to pay debt? It is important because it is effective to convert revenue that we receive it to cash. So how can I estimate if I have an future cash and have an additional finance? We have internal use of cash flows alongside with the cash budget. So it is assess the liquidity and in the short terms financing necessary. It determines the dividend policy if we're going to distribute the dividends or the profit, either it increases or decreases. It evaluates the investment as well, the financing decision. So cash flow consists of three main components: operating, investing, and finance. So it is not usually to have it in the net cash, it's positive or negative. We need to know how much enough cash or we don't have. So the cash flow statement linked with income, performance decisions, and the balance sheet, the financial position. So if we look to this importance, we find that we need to care about the cash flow because in some companies, when they do acquisitions, such as General Electric, they make a large number of acquisitions each year, and it is integral part in the growth strategy. General Electric was very successful in its acquisition, but other companies does not have this carefulness in taking into consideration the cash flow. So recently, a lot of companies fail to meet all their liquidity. So it is important to the company when they do acquisition to measure the performance of the cash flow, however they are including acquisition or not. So how I can prepare an adequate cash flow is a significant performance dimension, as it is dynamic from the short-term liquidity and the long-term solvency, in addition to the essential inputs for economic models. So the cash flow from operating activity, we need to start by the first part, coming income or cash or money received from the customers through sales of goods or services, or cash flow received from non-operating activities such as dividends, interest revenue, commission and fees, and cash payments to supplier or employee, cash flow from taxes and other expenses. In effect, the income statement is changed from accrual based to cash based. So we have two types of cash flow when we are going to prepare them, either direct versus the indirect. The two methods are commonly used. So the direct method is looking for the categories of gross operating cash flow, inflow and outflow, while the indirect is components of the three types of differences. What we are going to focus today is on the indirect methods, which components of or consist of the three types of difference. So the cash flow from operating are primarily the revenue generated from the activity of a company. Operating cash flow is conceptually near to the net profit, and it can be referred to the non-cash expenses. So what are the non-cash expenses? The depreciation, because it is non-cash item, just recorded in the recording systems. Non-operating items, for example, financial income gain or disposable tangible fixed assets, time differences of net profit, such as a cash flow from the inventory, account receivable, creditors, the many components that we are going to see when we're going to calculate the cash flow. So cash flow examples can be as well from the sales of goods, rendering services, receivable, which is reflected on the account receivable, receipts from taxes on sales, receipt from royalty fees, commissions, or I will pay for the suppliers, or payment to employee, or taxes or fines, let's say. So this is what we call it, example from operating activity. Cash flow from investing. So the most important item in investing is related to acquisition, to the long-term tangible and intangible assets and other investments. So the cash flow from investing activity are an indication of the company expansion. So we do a huge investment in plants, buildings, equipments, machines. So here you are going to pay for the acquiring the equipment or the building or any new investments. So the investments can be given via the firm's acquired property, plant and equipment, property, plant and equipment, we are going to give it the letter PPE, and tangible or intangible asset and other long-term assets and sales of assets. Loans extended to other company as well, and collection of such a loan. The last part, which is the finance, how can I finance all these investments or my operational, how can I contribute to the capital and financial debt of the company? So we have here examples such as receipts from issuing new shares or bonds, receipts from new bank loans, payments or buyback shares, if I'm going to repay back the shares, and repayments of loan, interest, and others. So examples of financing activity: cash receiving from the share capital, cash proceeds from issuing bonds. Let's say I issue bonds, and then from issuing this debt instruments, I have a huge amount of inflow of money. Cash repayments, or I repay the loans, it is an outflow. Cash payment to shareholders as that. So let's see, however, disposables of the fixed, and I have here the simple form of the cash flow from operating activity. So we start by the indirect cash flow here. We start by the net profit after tax. We're going to add the depreciation, provision then created, minus any disposable of any assets. So also we can deduct the related provision related and the gain of any disposable assets, in addition to the change in non-cash working capital. So here are the main items that we have it for the net cash flow from operating. So in order to classify either it is an inflow or an outflow, so let's say, for example, if I'm going to write an example that I have, for example, and account receivable, and it was 100 in the first year, and then the account receivable in the second year, it's become, let's say, for example, it's become 200. So here I have account receivable, and it changes in assets, current assets, and it is related to the working capital. So here what I have that the account receivable has been increased. The change that I have it is equal to 100, and it is a change by positive. So I have money outside, I didn't collect it yet. So this means that I didn't receive this money, then by the end, will be an outflow, and vice versa. If the account receivable has been declined, this means that I collect the money from outside, and this is an inflow. Let's do another way. Let's say instead of account receivable, this is inventory. and this is the inventory, it's equal 100, and then the inventory, it's become equal 200. This means that I have an increase in the current assets, and this increase by 100, then it will be an outflow. This outflow means that it is cash out of the company and vice versa. So this is the change in the assets. If we go for the liability, let's say that we go to do the what happened to the liability, what's going to happen to the change in the liability. So let's say I have here account payable, and the account payable was 100, and in the second year the accounts payable become 200, which means here that there is an increase of liability, current liability. So it will be an inflow. So the increase in liability, it will be an inflow, and the decrease, it will be an outflow. So this is simply in order to know what happened if there is an increase in assets or there decrease in liability. If I have, for example, depreciation, the depreciation will be an inflow. If I have an increase of loan, then this is inflow. If I'm paying dividends, then it will be an outflow. If I'm going to buy share, then it is outflow. If I have, let's say, for example, sell shares, then it is an inflow. So this is the movement of the cash flow, inflow and outflow. So I make a map for you for the operating activity. Here, from the sales of goods and services, this is an inflow. From the recipients of customer advances, this is another item. Recipient of interest or dividends or rent or similar. So all of these inflow. To wages, I'm paying, buying purchases of inventory. To supplier for purchases of inventory, I pay operating expenses, I pay interest, I pay tax payment, advance payments. So I pay for the operating activities. So this is representing the types of operating, here inflow, and this is an outflow. If we go for the investment activity, from the sale of, I'm going to sell planet, building, any equipments and other long-term assets. So if I sell, this means an inflow. If I purchase, then it's an outflow. So from the sale of common or preferred stocks, so from issuing short terms, so from the sale, I sell my preferred stock, I sell my common stock, this is an inflow. If I am going to buy my shares, this is an outflow. I pay dividends, outflow. I pay the debts, it's an outflow. So this is a map for giving you the different types of the example for both the inflow and outflow. So cash flow proxy, so here we start by the net profit, add depreciation, the provision created in the year, and then deducted the provision released in the same year. This is called the cash flow from operating. If I'm going to add the depreciation for the years, provision release, gain and assets, net change of non-cash. So this is the cash flow from operating activities. Cash flow from investing, and then cash flow from finance. So we have the net cash. We are going to add the beginning cash and the ending cash. So I will provide you constructed the cash flow. So we need to determine the net change in cash, what happened, the beginning and the ending. And then we identify all the transaction during the period. So we need to analyze the movement, either the direct or the indirect transactions. And we're going to do the first steps, and the second step to construct the cash flow. So the information for operating flow is primarily derived from the balance in the balances in the income statement, while the information from the two other principal categories come from the balance sheet. So the movement in the accounts indicated a change in financial position, and further examination is needed to determine if they had a cash impact or not. Check if balance have been impacted by the accrual-based adjustment or non-cash activity. So I give you an example here. You have here a very simple example for company XYZ. And as you see here, we need to prepare the cash flow. So I provide you with two sides of the balance sheet statements in order to prepare my cash flow. I tried to explain with you first the differences in cash. The differences here in the cash in 2007, 39, and in 2008, it decreases. So there is a decrease in cash. Notes receivable, it was 50, and then it's become 69. So I'm going to write a little bit of comments here in order to reflect. So here we have here that the notes receivable from loans and other companies, it has been increased, and this is can be reflected in an inflow. Uh, so if I have an account receivable, the account receivable here has been increased, and this is will be plus as well. So it is 13,800. This is the changes that happened from account receivable. At the account receivable, it was 39, and it's become, so there is an increase in the assets. Then this means an outflow. 120 and become 158. So this is the plus over multiplying inventory. So this is will be an outflow as well. So this is the change. I'm just writing the changes, but it does not mean this plus or minus, it is an outflow and inflow. So if we go for the interest received, it was as well, this is the interest received. So any increase in the assets, all the values increase in the assets. If you see here as well, it is also increase in the land, it is increased as well in the prepaid operating expenses. All these increases means that these are represented in the forms of increase in assets, and it will be outflow, except that we see here that the property, plant, and all these items has been declined, and the decline of planet properties, equipment here, the drop means that there is an inflow. So this is simply the meaning of the changes. So if the change is positive, as we see here, then it is an outflow. If it is negative, then it is an inflow. This is what we're going to look for. Vice versa for the liability. If you look for the liability, you will see here as well, all the liabilities here, the majority of them, 38, 45, all of them has been in a positive change. And if you look for the majority of them, except for the returned earnings, where we're going to explain it in a separate formula, we have here an increase in all items, and this increase in all these items, this means that the liability has been increased. This is called an inflow. And this is what we're going to explain it in the coming slide. So basically, we construct the XYZ company, and we see the items that we have it from the income balance sheet. So I will need as well the income statement, and this income statement is giving me the most important two items. We have here the depreciation, and we have here the net income, which are the two main importance, so that we are going to start with the cash flow statement. So I'm going to look for the net income, which is the 74,000. It's important for me, and the depreciation, which is the second item, which is the depreciation, and as well the loss on sales of equipment, the loss of sales of my equipments, which is minus 4,000, and it will be an inflow. So I have here three items. The depreciation, it is a non-cash item, 43, and then I will add to it to the net income, which is the 74,000, in addition to the most important item, which is the 4,000, which is the loss on sales of equipment. Here the company pay notes, and the companies sell equipments with the cost of 12K, and we have also receiving a notes, and we purchase an equipment, and these are the all items that has been clarified. So we start to buy the cash flow, and the cash flow here it is 74K, and this is the net income, and this is we bring it from the income statement, adding to it to the depreciation, and subtracting from it adding to it the loss of equipment sold. So all the inflow of cash come from the income, come from the depreciation, which is the non-cash item, and this loss on sales of equipment. So we start by having 121K, at the terms of equipment. Let's go for the other changes. We see here that we have a change in account payable, wage payable, tax payable. So if I go back for these items, where we find these items, so we have here accounts payable, wage payable, income tax payable. These are the most important item that you see here. And you will have as well unearned revenue 1,000. So if you look to these three, 7,000 account payable, first item, accrual wages, and we have here income taxable and the unearned revenues. All these items were going to be included in the operating, and this is what represent the inflow item. So why? Because this is our the liability, and this is cash that I received inside the company. If I go for the other side, which is the 13,800, which is the increase in account receivable outflow, that you have a change in inventory 38,000, which is an outflow. And we have also a prepaid operating expenses at 300 here, which is as well outflow. Interest received as well, it is an outflow, and all of these represented in the operating expenses. So these are the components that we have it. So don't forget that we have the 74K and the 43K as well, depreciation, and the 4K sales of equipment. So we are going to add the changes in increase in cash and the changes in increase of liability. So the total cash flow that comes from the three components of, so we have 52,900, 52,000 for 900 and 10,350, adding to them what? Adding to them the 121. So we have here 121 plus 10,350 minus the 52. So we start our cash flow from operating with 78,450. So let's go for the second items, which is the buying of all the equipments and the machines and the lands here. So we invest in all these equipment. So this is represent 108,000 outflow of money because we are investing in this machines, equipments, and land. And how can I going to finance them? I'm going to finance them through notes payable. It is in the liability, common stock, paid in capital. These are all the ways of paying for the company, financing the company investments and operating. And then we have to repay payments of bank. If you go back to the loans and we look for the balance sheet. So if we go for the balance sheet, we are going to see that we have here the loans, and these loans are going to be the repayments of loan, and the repayments of loan here, it will be reflected in the items of the liability, and this is will help me to finance my payments of bank loan. This 50,000, this is the payment of bank loan, and it is very clear here in this item that note that I have a 50K banks loan that I have to include it in the financing activity. But what happened to the dividends? How can I calculate the dividends? So if we look for the dividends here, that payment of dividends, so I have here two items. It's very important for me. So I have to look for the net profit and the change in returned earnings. The change in returned earnings. So what we see here in the returned earnings, so if you look to the change in the returned earnings, 36,800. 36,800. And I will go to the net income. So if I want to find here the dividends, so my dividends, how can I find it? My dividends. So it will be the net income I have minus a change in returned earning. So if we have here the change of returned earnings minus the change, so I have to put here the 74,000 minus the change, which we know just right now, 36,800. So if you use your calculator and to find the changes, then it will be 74,000 minus the 36,800, then it will be 37,200. This 37,200, it is the dividends, and it will be an outflow in my cash flow. So I leave this point in order to see if it is correct or not. I will go for the payments, then it is correct, 37,200. So this is the, if I add all of them, this is will give me the cash flow from financing. So if we make the summation of all the three items, the cash flow from operating, the cash flow from financing, the cash flow from investment, then we can have the net cash flow that we have it in our statements. So this is basically the net cash flow. If I want to confirm it is correct or not, if you go back and look to the changes in the cash flow here, it was 1,750. So by this way, we calculate the cash flow from the three items, wishing you understood the cash flow. Best of success. See you in the next video.